Hello and welcome. I hope you're doing well. In this video, I'm talking about the India-US taxation on Gift City, the IFSC, the investments in the units in the IFSC, and factors that you need to consider before investing. Right. So, okay. First, a disclaimer. This video is based on the regulatory position as it stands on March 4th, 2025, the date that I'm making this video. Now, the regulations in Gift City are fast evolving. I mean, every month, IFSCA, the authority, the regulatory authority for IFSC, is releasing new regulations. There are changes that are happening in FEMA. There have been changes in the Finance Bill 2025, which are yet to be approved. So, a lot of action is happening in making Gift City, bringing new products. Companies are bringing new products and schemes as they are doing. So, the regulations are fast evolving. I'm just making this video as on this date, and I will definitely make an updated video in a few months, and by that time my understanding will also deepen, because this is a slightly complicated subject, right? And with respect to when I'm saying about investing, the content is not investment advice, so please check with your investment advisor before taking a investment decision. So just an introduction first on what is IFSC. So this is like India's first international financial services center. Aim is to create a globally competitive hub, international finance hub, like we have DIFC, Dubai, Singapore, those kind of hubs that India has attempted to create. Now, good thing about good, I don't know how good, how bad, but there is a single regulator, right? Now, apart from, like, if you see the normal Indian investments, there are separate regulators, like RBI is there for the banking, SEBI is there for the all other mutual funds and all. Then there are PFRDA and other regulators are there. Here, there is only one regulator for all the financial products within the IFSC. That financial regulator, IFSCA, will give the approval to the companies. It has given clear guidelines on how the products have to be structured, and then as the companies will file their products, it will give the approval. So the aim is basically to kind of streamline the whole thing, have only one regulator, easy for companies to set up business in IFSCA, and roll out new products, new schemes, and a single window kind of a scheme and all. It's all good on paper as of now, right? So but remains to be seen how it is actually implemented, right? But it's there is only one single regulator here. Now there is a single window regulatory mechanism, preferential taxes. So it's a very good, like, the real benefit of IFSC is for a unit which is setting up kind of a business in IFSC, where they get 10-year tax holiday, plus subsidies or grants, or a lot of other things also by the Gujarat government also. So all those things, reduced corporate rates, tax holidays. Now now we are talking, from what I have made this video is mainly with respect to individuals, right, who maybe would like to invest in IFSC, because the currency in which one can invest is USD, and other currencies as well, non INR currencies, right? So from that perspective, my aim is whether it is right, good, not good, what is the taxation. So NRIs as well as residents both can invest in various financial products as are structured within. So what basically is that a company sets up as a IFSC company, IFSC unit, like ICICI Bank IFSC unit sets up in the IFSC, and then they are given approval by the IFSCA, and then they start launching various products which are in line with the IFSCA fund management regulations, right? So that's the whole structure. So both NRIs and residents can invest. For residents, they fall within the LRS limit of 2,50,000, which we will discuss later on. So both NRIs and both, and it's not only NRIs, non-residents. So basically, the whole aim seems to be to bring non-resident funds in India through these IFSC hub, right? So instead of NRI, it should be non-residents. Non-residents and residents both can invest, right? Even foreign citizens, right? Okay, FEMA regulations do not apply. So FEMA, there is a specific regulation which says that the FEMA regulations do not apply for the units in the IFSC, right? So any unit that is set up in the IFSC, for example, ICICI Bank IFSC unit, right? They are considered person resident outside India for FEMA regulation. So it's not say, I will not say, maybe I need to reword this. It's not that FEMA regulations do not apply. It's just that those units are considered as persons resident outside India for all FEMA regulation purposes, right? So they are not considered persons resident in India, right? Okay. Now IFSC is part of India for income tax purposes. So if you see the Income Tax Act, under the definition of India, it does not exclude IFSCs, right? So in for purposes of Income Tax Act, uh, a unit income generated in the IFSC still constitutes an income generated in India, and the taxation of the income, and this is very important, taxation of the incomes that originate in IFSCs still form part of the Indian tax rules under the Income Tax Act 1961, and now the new Income Tax Act that will come 2025, right? So it will fall in the purview. So Indian government reserves the right to make any changes in the tax rules on any incomes that are there in IFSC. So we cannot think that, okay, if you have invested in IFSC, it's something sacrosanct. It can always be changed as per the Finance Act, changes that can happen. So that uncertainty is always there. If any tax rules change any beneficial treatment or not, they should not, but then we cannot say. So this is about just an introduction. Now let us come on the Indian taxation and the FEMA. Right now, see, whatever I could. It's a complicated area. I have done my research. Whatever I could jot down, I have jot down. Please share your feedback. So first is with respect to dividend income. Now, dividend income with respect to non-resident. See, if you see the whole structure of the from a taxation angle, now Section 10 of the Income Tax Act exempts incomes, right? And if you see, the major kind of thrust is to exempt the income with respect to non-residents, right? So major thrust is to make this IFSC a kind of uh, attractive place for non-residents to invest, right? So here the dividends are taxed at 10% plus surcharge and cess under Section 115A for non-residents. Now, as regards resident, normal tax rules would apply, and with respect to non-residents, now generally non-residents try to take an advantage under the DTA. If, like, for example, the tax rate is 20% for a normal kind of an investment in India, and the DTA says 10%, they would want to seek a 10% preferential rate. But here itself, if you see that 10% is given under the Indian tax law, so there is a limited need for the NRI to seek a tax benefit under the DTA. So this is a kind of a positive step. Okay, now coming to interest on bank accounts, fixed deposits. So now IFSC, you can see there are a lot of banks that have come, ICICI and HDFC, SBI, all these banks have come, and they have and there is now a permission for the for by the under the FEMA that residents can also open foreign currency accounts, and non-residents can also open foreign currency accounts, and also fixed deposits. Now, interest on bank accounts or fixed deposits are tax free for non residents under 1015. However, normal taxation rules apply for residents. Now, an important thing understand here is, if you are a returning NRI, maybe returning from US, and you have 2 years of RNOR phase. So, if you are on RNOR, you are still a resident, right? If you see under the Section 10 for FCNR and RFC deposits, there is it's very clearly exemption is given that if you are RNOR, then there is no tax. It's tax free. However, that clarity is yet not there. So if you have made investments in IFSC, the interest is exempt. For non-residents, it is exempt. But for residents, that clarity is not there. It seems to be that the normal taxation rules will apply to residents, including those on the RNOR status. Now, investment income for non-residents from portfolio of security. Now, in IFSC, the banks and all can also launch kind of PMS schemes or any other financial products. So the investment income of non-residents from such schemes, plus there are certain other incomes like derivative contracts and all, that are exempt under 4G and 4E, Section 10, 4G, 4E. That is also, so again, this exemption is for non-residents. Then there is a provision with respect to ULIP. Now, ULIP, this finance bill has made certain changes, right? So now what there is a tax arbitrage possibility, both for non-residents as well as for residents who are investing in a gift city ULIP, right? So there are basically two restrictions. One is that the annual premium should be less than 10% of the sum assured, and second is that the annual premium should be below 2.5 lakh for ULIP policies and 5 lakh for traditional policies, for it to be treated for the receipts to be treated as exempt under 1010D. Now, under the changes that have been made in the Finance Bill 2025, proposed changes, right? So what what they have actually done is that there is no requirement of the annual premium below 2.55 lakhs as are applicable for regular policies. Now, this is basically, this may be a kind of a oversight error by the drafters of the finance bill, and it may be plugged by the time finance bill becomes an act. So as on date, the position stands is that if there is a ULIP policy in the gift city that you purchase, and as long as the premium is less than 10% of the sum assured, and the annual premium can be anywhere, it can be 50 lakhs, 1 crore, whatever annual premium is there, it is exempt under 1010D. Now, this seems to be some error, and let's see if this is genuinely made, or it's a error that is plugged. So that remains to be seen. So currently, as per my reading of the law, it is this arbitrage possibility of investing in a ULIP policy is available both for non-residents and residents. So let us see how this thing shapes out. We will get a clarity when the finance bill is passed near the maybe end of March, right? End of March 2025, right? Okay. Now AIF. Now AIF. So see, as per what I have read, as per the IFSCA fund management regulations, uh, currently the products are AIF which have been released. I don't have the exact idea of which AIF products are available, because it's mostly considered as a private placement and limited public data is available. But there is one category of products which are AIF, alternate investment funds, which have a very high ticket size and a specific way this is tax, which I'll come to. But there are other schemes, retail schemes, ETFs and all, which are also allowed under the IFSCA regulations, which seems to be not yet launched. However, with respect to the AIF, the taxation will work like this. So AIF, basically there are three forms of AIFs: category 1, category 2, category 3. So generally for category 1 and category 2, it's the same taxation. How it works: income is taxed at a pass-through level, right, in the hands of the investor, right? So basically so a pass-through taxation mechanism applies, right? So like for example, you have single member LLC in US, right, which doesn't elect to be a C corp. So basically what happens is the income flows in your personal 1040. Similar way here, the income flows directly in the hands of the investor. It is not taxed at the fund level, right? So here what happens is the investor is actually taxed on that funds, and he can also claim the foreign tax credit because he has paid the tax in India. There is also a provision of tax reduction at 10% for residents and 30% for non-residents. However, there is a 0% tax and TDS if the income is exempt under 4G, 10-4G, right? So the normal rule is 10% for resident, 30%, which is the rates in force for non-resident, but 0% tax if the income is exempt, right? So this is the taxation for Cat 1 and Cat 2 AIFs, right? So you have to be clear when you're investing what AIF category it falls to, because accordingly the taxation will happen. Now we come to Cat 3. Cat 3 AIFs is basically taxed as per the corporate structure at the fund level. So if it's a company and there is an income, it will be taxed as per the whatever the rates that are applicable at the company level, and it will be tax free in the hands of the investor. Right now, when we are saying that it will be taxed at the company's hands, we may like interpret it that the in-hand returns in the hands of the investor will be less. However, there is a specific exemption for income earned by specific funds, retail scheme, or ETF, right? Because the IFSCA regulation per se allows specific funds, retail schemes, ETFs, and under the income tax to be launched. To IFSC allows these schemes to be launched. However, the companies are yet to launch those schemes. But as and when the schemes are launched under Section 10(4)(d), the if the units, all the units of that fund are held by non-residents, the income of those specified fund, retail scheme, ETF will be tax free in the hands of the company. So the return basically for the investor is high because the income is and not taxed, right? So again, please understand, here the condition is that all the units are held by non-resident, right? So the thrust is the thrust is on basically making it more tax attractive for the non-residents, right? Okay. Now, a financial institution set up in IFSC. Okay, here just I want to clarify, when we are talking about specified funds, retail schemes, ETFs, specified funds they are considered as Cat 3 AIFs, right? Under Section 10(4)(d), right? Okay. Now, financial institutions set up in IFSC are considered persons resident outside India, that we have already discussed. Okay, now good things about the gift city is that there is no like FEMA complications. Like for example, a NRI who would otherwise be investing in India can only invest through the PIS, non-PIS route, and all the compliances that are associated. So those compliances are not there. And for non-residents who do not have any income chargeable to tax in India, for example, people who are like foreign citizens or foreign institutions, right? For example, if you're a returning NRI, you definitely have an NRO account which will be yielding some interest income. So you will not fall in this. But if the person is like a foreign institutional investor or a foreign citizen who doesn't have any income chargeable to tax in India, then there is not even a need of a PAN, right? Now, how administratively this all will be made possible remains to be seen, right? There will be teething problems at the initial stage. Okay, now very very important thing. Now if you are a resident, if you're an Indian resident, for example, you return from the US, right, after so many years of working, and you are now in India, and you have funds which are there in the US, but because of the estate tax and all, you want to kind of move it into a gift city. Now as a resident, if the money is you have already transferred into INR and you are an Indian resident, you are bound by a LRS limit of 2,50,000. You cannot contribute more than $250,000 per year. You cannot remit it to the IFS unit. So previously, what the regulation was that only for limited purposes you can remit, like for education and investments. Now it is they have simplified it. They are saying for any current or capital account transaction, you can remit the funds to the IFSC. Now, there are again specific challenges here, which we will discuss later. But FEMA also now allows a resident to open a foreign currency account in an IFSC. So that is also specifically now allowed. Now let us come to the US tax side, right? This is basically for those who are living in US, they are US residents, maybe planning to return back to India, or may not be planning to return back to India, but they are considering to invest in IFSC because a lot of hype is built, and especially by product, basically those who earn a commission from from the income, from the sales they make in Gift City. So uh, let us first come to the US tax side. Okay, so first thing is very important to understand is that if that see, IFSC is being marketed as kind of tax free for non-residents. Yes, even there, when you talk about tax free for non-resident, there are ifs and buts under section 10, right? So it has to be very carefully evaluated whether a particular investment is actually tax free, because the whole idea seems to be that the money that is collected from outside India is not invested in India. The investment has will be made outside India. Then only the relief will be there. So now, even though an income, so suppose you invest as a US resident. Who is a US resident? A person who is either US citizen, green card holder, or a person who is fulfilling the substantial presence test in US. So if you're a US person, then worldwide income is taxable to you in US, right? So even though you earn an income from in the IFSC, which is tax free in India, but it will be taxable in US. So if you're a US resident, practically nothing is tax free for you. The NRE, FDs, and everything, right? There is nothing that is tax free for you. It will be taxable to you in US if you're a US resident. Now, tax resident. Now, income, how it will be taxed is that no, the how the categorization happens is that the AIF will do the transactions and it will earn income. Right now, good amendment that has brought in under section 214, hopefully 214 for the capital asset is that basically whatever the transactions are there in securities, previously there was no clarity that it may be qualifying as business income, taxable at maximum marginal rate. However, now that with the new finance bill amendment, it is capital gain. So that clarity is there that the EF is doing any transactions, it will be uh, treated as a capital gain. So accordingly, the same characterization will happen to you. So either the income is ordinary income, or most likely it will be capital gains. So the AIF is supposed to give you a statement showing that okay, in this particular year you have earned this income and this is a characterization. Accordingly, that characterization you can use for taxation in US. So again, in US the taxation is different, 0, 15, 20% depending upon your income. So that way it will be taxed at US federal as well as state level if you're a state resident, right? So that will be the taxation in US. Again, very important. I just forgot to include that in this slide about the F bar form 8938, right? So if you have non-US investments, so US doesn't like people investing, their tax residents investing outside of the US. So you need to ensure F bar and form 8938 for even the investments in Gift City, right? So, and because investments in Gift City have a high ticket size, so most likely it may breach the F bar, which is 10,000 threshold, and the form 8938 thresholds. So that you need to make the keep in mind those reporting requirements in US. I forgot to include this in this particular slide. Okay, now for cat 1 and 2, now cat 1 and 2 AIFs, if you are holding, then what happens is that it is a pass through taxation, right? So you are taxed in India as at the investor level in your ITR, right? So you can claim the FTC of the tax paid in India. However, please understand the challenges with respect to claiming the FTC in US, right? US doesn't give the full FTC. It only gives you proportionately, right? So that is why one of the reasons, right? One of the many reasons why I say that if till you are US resident, better to invest in US only, right? So for cat 1 and 2, it is easy. You can at least claim the FTC by filing form 1116 with your US tax return and claim the proportionate FTC. Please remember, some states don't even give the credit of the other countries. Problem is for cat 3, right? For cat 3, I will come, I have covered it in the practical issues section, right? Problem will be in cat 3, whereby the fund doesn't deduct, the fund is taxed and the individual is not taxed, right? Now, if you invest in AIF, this is very important. If you invest in any AIF and any ULIP investments, they all qualify as PFIC under the US tax law. So if it's a PFIC and the investment crosses, I think 50,000 USD threshold for married filing joint, there is a separate filing requirement of Form 8627 per year per scheme in US, right? And so that is a reporting requirement that you need to adhere to. And if the fund is not listed, I've made separate video on PFIC tax implications. You can check that video also. Now, if the fund is not listed, now as per my reading, I've not like read it very thoroughly, but not every fund needs to be listed, right? So if the fund is not listed, then you cannot choose a MTM election whereby you offer unrealized gains to tax every year. It is only for listed funds, right? So that election, see if the fund is listed or not. Accordingly, you can choose the MTM or not. Now you can still explore a qualified electing fund election if maybe, I don't know, if the AIF, if the fund's ticket size is so high, maybe $150,000 more than that, maybe the AIF has a mechanism that if you are a US resident, they can provide the whatever details are required for making that QEF election. So you can check with the AIF before making the investment whether you'll get the QE the information for making the QEF election. Indian financial institutions generally do not provide this, right? Okay. So very important that PFIC will get attracted. You'll have to file the report with your tax return every year, and God forbid, if you make a withdrawal, then very complicated PFIC, the tax regime will apply under Section 1291. Uh, or hopefully, if you have made a MTM election or a QEF election, it may be easier, right? So that you need to keep in mind if you are investing, right? Okay. Now, some practical issues. There are actually many. There should be many more, but whatever I could just find out and jot down, I am just jotting it down. So these practical issues are there. So now, if funds are repatriated to IFSC, so, for example, if a resident has repatriated I'm talking here about residents, right? This is for residents. So, if resident has repatriated funds to IFSC under LRS of 2,50,000 and the funds are lying in the IFSC unit bank account, is there a requirement to repatriate it back? Because under LRS, how the rules are is that if you are remitting some amount outside India for the permitted purposes, if the amounts are not used, they have to be repatriated back to India, right? Within 180 days. Now, will that same rule applies to IFSC? In my view, yes, right? Unless the RBI offers some contrary clarification. So, in my view, yes, you cannot just keep the funds in a bank account. You have to either invest, and even if you sell, the money comes in your bank account. You have to either invest it somewhere. You cannot just keep it lying idle in the IFSC. But we have to wait to see if any clarification is there. Now, whether IFSC investments qualify for exemption, this is actually important. This is actually important, especially for returning NRIs who are returning from US with their funds. So generally, if a person who was a non-resident and who had been earning income outside India and it is there in the US bank accounts or US investments, FEMA allows under Section 6(4) to keep those investments, and no need to bring it to India, right? Under Section 6(4), that is allowed. However, the language of 6(4) is basically the foreign currency immovable property situated outside India, right? Now, the wording of India is not defined under the FEMA Act. It may be defined other elsewhere, but FEMA Act 6(4), where it is 6(4), that act does not define IFSC to be a part outside India. So my question is that if the amount which is withdrawn from maybe US brokerage and shifted to an IFSC, will that be part of India, or will that be outside India, right? So that a slight kind of a confusion is there, whether the investment in IFSC would qualify under 6(4) of FEMA or will it not, right? So that is again a slightly gray area. Now, whether investment in IFSC qualifies as a foreign asset. Now, India has specific rules with Income Tax Act and the Black Money Act, and with respect to taxation rules on foreign assets under the RNOR period. Now, whether investments in IFSC qualify as foreign asset, because if it does qualify as a foreign asset, there is no tax, there is no reporting requirements under the RNOR phase, right? So that clarity is currently not there, because in the definition of Income Tax Act 1961, uh, the word India does not exclude IFSC. So in my view, IFSC investment in IFSC does not qualify as investment outside India. It is an investment in India. So suppose you have returned back to India after a stint in US and you then transfer the assets, US assets, to the IFSC. In my view, they will still be taxable to you even during the R0 phase, which then takes away the entire tax benefit which could otherwise have been taken if you are in RNOR and you maybe have funds in US or maybe in Irish domiciled funds, right? So that this is a very important clarification that needs to be sought, right? Okay. For category 3 AIFs, now this is a practical challenge. For Cat 1 and 2, you can claim the FTC in US or the tax that you paid in India. But what happens to Cat 3? Now, Cat 3, now again, Cat 3, the income is tax free in India, tax free to you in India, right? However, for US tax purposes, in my view, the corresponding share of the income which was taxed at a fund level, you need to offer that income to tax in US. However, will you be able to receive the FTC? Because the tax has been paid by the company, by the institution, and not you. So you will not have any documentation of the tax paid. Is there some mechanism whereby US will give you tax of the FTC basis some documentation where the uh, first of all, whether the AIF will give you the tax paid documentation that we have paid. So if you have 100 rupees, out of that 20 rupees which pertains to that 100 rupees, we have paid tax on your behalf. Unless that documentation is available, how difficult it is for you to claim FTC? What documentation will you have? So this is again a practical challenge with respect to category 3 AIFs, where the income of the AIF is taxable. In case of specified funds or other cases where the income is not taxable, then in that case there will be no question of FTC, right? Now, comparative tax benefit against FCR, FCNR, RFC if in the RN. So if in the RNOR phase, this very clear that FCNR non-taxable for non-residents as well as for people who have returned back to India and are in the RNOR phase. Similarly, RFC till RNOR no tax. But that kind of a similar provision for residents is not there. At least I could not find it in the Income Tax Act section 10. So that clarity needs to be. So see why the residents will invest, or returning NRIs will invest if you put them at par with respect to taxation, similarly as to the non-residents, right? If you don't put them at par and don't give that clarity, maybe returning NRIs would preferably keep, it may be better for them to keep their money back in the US, or in Ireland or explore other jurisdictions like Singapore and not bring it back to the IFSC, or maybe the Indian RFC account, but not in the IFSC. So that clarification needs to be there. Now, Gift City, what are the options? Now, again, I'm not an investment advisor and I have not done that much research, but yes, there are bank accounts. There are banks that have come in the IFSC. They offer fixed deposit. So a lot of banks are pushing their fixed deposits now, right? I spoke to some of the banks. They are just for details, but they are just pushing their fixed deposits. So that is one thing, that they are pushing their fixed deposit. That please invest in the Gift City fixed deposits, right? Then insurance come investment plans. I think there are, one is the India First life insurance, which has a wealth plan. There is HDFC Life. But actually, the problem is that even if you go and talk to the representatives of these companies, they are actually also not very clear on the finer aspects. They just have been told that you just push this product and they do that. So that finer understanding is not there in the, not even with them, and also within the professional community also, that because since it's a new development, everyone needs to gear up in their understanding of these the investments and the structure and new development that are taking place every day, right? So ULIP, insurance come investment plans, some companies have launched. AIF, they may be there, but I'm not sure the exact details since they are not very publicly available. Retail schemes, MF ETF, they have not been launched as yet to what I know, but they are very well permitted under the IFSC fund management regulations. So needs to be seen. And also there are enabling provisions under the Income Tax Act where the income is exempt, but needs to be seen how, in which structure they come, what are the costs, charges, everything that needs to be seen. Now, whether to invest or not, so I cannot guide you. I'm not an investment advisor. Content is not investment advice, but some thought pointers, especially from the perspective of NRIs who are returning back to India, and who suffer the estate tax risk in US on their investments. Now, in US also there is this talk going on with respect. There's a new bill that is introduced with respect to that, estate tax to be repealed. But again, it's uncertain whether it will see light at the end of the day. If that does, then all the problems will be removed. Uh, but some thought pointers on returning NRIs who may want to consider Gift City. So first of all, there has to be a very convincing reason for the benefit in investing in IFSC, right? Over and above the normal US India investments, right? So one thing is that it has to be evaluated holistically, not only from a tax angle, but from the product cost angle. So I always prefer to and advise that you should check. First of all, investment should be a diversified investment, right? It should be diversified, low cost investment, and your main focus should be the asset allocation, right? Allocation between the various asset classes, and there should be some kind of a rule based asset allocation, right? That is the real differentiator, and not how much returns a product gives. Maybe for some investors, like high net worth investors, the returns and all become a priority, but for normal investors, asset allocation should be the priority, right? So again, so this is very complex. So you need to have a very convincing reason to switch your investments from US. Definitely you would want to move out a big chunk of the investments because of the estate tax, or buy pure term insurance. I've made separate videos on estate tax restrictions, estate tax risk, and how returning NRI can cover. There are various methods I have suggested. So either you can use those methods or then buy term insurance, right? That's one way. Shift to Irish domicile funds. That is another legitimate way to avoid. Then another option is RFC. So if you are saying that I don't want those options and you want to move to IFSC, there has to be a convincing reason why. What is the additional benefit that you're getting, right? For example, we discussed about RFC is tax free under in the RNOR phase. However, it's not clear whether those investments, if you make in the USD in Gift City as a resident, whether they, so that clarity has to be there. Then also you need to have a clarity with respect to why IFSC and not Ireland, or not DIFC, or not Singapore, right? So what is the comparative kind of a pros and cons that need to be evaluated, because it is going to be a big decision, right? One is this thing that the ease of having the investment back in India, in my view, only that thing should not be your concern. I mean, only that thing should not be the sole deciding factor, that okay, my investment is there in USD and my investment is there in India. I think that should not be the sole deciding factor. Now, ease of accessing, which is what the point we are discussing, that yes, one thing can be, this is a point which can go in favor of the IFSC, is that the ease of accessing funds. You can speak to the people who are like Indians vis-a-vis US, Ireland, Dubai. What if something happens to you and your family will have to kind of reach out to those institutions and for getting the money? That is one of the concerns that can happen, and that goes in favor of shifting funds in the IFSC. Now, then one point, this is my particular view, is that, and I always say that general rule should be that where your expenses are going to be there you should keep the money, a big chunk of your money, so as to remove any possibility of currencies. However, given the Indian government's kind of flip flop policies on tax, for example, if you see last year what they did, the change with respect to removing indexation, all of a sudden there was a practice that was there, and which is a right way to tax capital gains, the indexation. They just removed the indexation just like that, saying that now we are making it 12.5, so we are removing indexation. And then when they made the changes, there was this pushback, and then they rolled back and they said that okay, grandfathering will be done with respect to those investments prior to 23rd July 2024. And even that, if you see, they did not give the same exemption to non-residents. So considering this kind of a flip-flop strategy by the Indian government, instead of simplifying things, they make things more complicated, right? So even if you see the TCS provision of 20%, so people who have transferred money to India, now they face a 20% TCS on repatriating money outside India. Then the whole thing around crypto, how they have taxed crypto and the TCS and all provisions which have harmed the crypto industry. So my one of my views is that it can be a regulatory hedge, kind of to keep some money, some chunk of money outside India, so that is not exposed to the flip flops with respect to taxation by the Indian government. Maybe a very kind of a sound jurisdictions like Ireland is very good, Dubai is very good, right? So Singapore is excellent jurisdiction, right? So that thing also needs to be considered. I'm not saying that IFSC is not good. I'm saying to make a decision with respect to your funds, you have, IFSC is not the only choice. Yes, there will be people who will be pushing you to invest in IFSC because their interests are aligned to you investing in the IFSC. But my view, you should take a holistic decision and maybe consult an investment advisor who can invest you properly and give a kind of analysis on various available options, or a wealth manager who can then and then you can decide. Okay. um, right. Now, not much benefit for residents, right? So as I've already said in the video, there is not much benefits that I can see for residents or those funds that invest in India. The main aim seems that for the non-residents who are investing otherwise out of India through the other financial hubs, they've created this one financial hub where they are saying that don't invest through Singapore, invest through us, right? So the main aim is for non-resident institutions, primarily the institutions, so that the outbound investment can be made. Now there are certain restrictions. Tax benefits are not available if those particular funds invest into India, right? So I don't know how they have, what is the main intent of creating an IFSC with these all restrictions. So if you are investing, you have to be very clear on what kind of tax benefits that you get. So because of the whole kind of regulatory sea changes that are happening, that is why you need to be very careful, especially residents, right? Okay. Now, lack of clarity on certain tax benefits, which we have already discussed, on the regulatory aspects. Then the ULIP tax arbitrage that is there, that may be plugged either in this finance bill by the time it becomes the act, or then we'll have to maybe next finance bill it can be plugged. So need for more. Then certain investments. So what happens is, Income Tax Act says that certain investments which, for example, regulated by SEBI, which will be granted a, or a PFRDA, like NPS, will be granted a tax benefit. However, now they have to make changes as new schemes are launched in the gift city. They have to make corresponding tax changes in the Income Tax Act to include the wording that regulated in the International Financial Services Center. That wordings have to be added. Otherwise, you kind of launch a particular product, but that corresponding tax benefit may not be available to you. So this finance bill is not now over. Maybe we'll have to wait for the changes either through some rules amendment or through the next kind of a finance bill. So all that is has to be seen. Okay, no tax-free advantage for US NRI. So if you are a US NRI based in US, please understand it. Nothing is tax-free. Everything is taxable to you. Plus, you get the added PFIC compliance and taxation hassle. So my view is always that if as long as you are a US resident, invest in US, right? Because of the all the PFIC, FATCA, FBAR, FORM 8938 challenges, lot of those challenges are there. Better to invest in US, and when you are in US you can invest in India dedicated funds like Flynn, right? Rather than investing here and facing all these challenges here, right? uh, then investments on AIF route. If you are thinking of investments in AIF, please bear in mind it involves a very high ticket size. A lot of your fund will get blocked, which is not advisable. It has a longer lock-in, it has high charges, and the investments that the fund makes, right? Fund is what? AIF is a feeder fund, which then invests in other funds. The funds or the products that the AIF makes investments are slightly non-conventional, carries a higher amount of risk. So, are you as an investor prepared for that kind of a risk and that kind of a lock-in, right? So, consult your investment advisor before taking a decision, right? AIF investments are more suited to super high net worth kind of investors. So we'll have to wait for the retail investors. So my view, already you must be kind of by now aware of what my view is. So my view is that IFSC is work in progress, right? So stay away from making any investment despite kind of the push that is there till regulatory clarity is available under the law. And the products that are launched are retail products. They are low cost, have low charges, and there are no such lock-ins, and their performance can be evaluated. The publicly available data is available, so that to evaluate their performance. And also there is a comparative advantage of investing in the Indian IFSC vis-a-vis other jurisdictions, right? So the my point is only that the ease of and the comfort that my investment is there in USD and in India should not be the sole deciding factor. It is one of the deciding factors, right? Okay. Till then, my suggestion will be to continue with the India US investment strategy with that you have. There are strategies that returning NRIs can have with respect to Irish domiciled ETFs, liquidating a certain part of the US portfolio, investing in 5 to 9 plans, RFC accounts. So all that I've discussed in separate video on estate tax. So those strategies should continue to be followed, uh, uh, and we'll have to wait till we have a clarity for Gift City, and then we can also include Gift City in that. Please beware of the sales pitch by product salesmen and agents. They only show you the nice picture without getting into the intricacies. I hope this video has maybe served that purpose, to tell you about certain of the kind of points where which are not good, or where the clarity is not yet available, right? So you have to take a holistic decision. And if you are considering to invest, check with the RIA, a fee only registered investment advisor. And even the RIA community has to, and even all the tax professionals as well as all the professionals have to come up the curve, because of the the changes at such fast pace that is happening in the Gift City. So we all, even professionals, have to gear up, and it has to be a considered decision has to be taken before making the leap with respect to Gift City. So I hope this was useful. And okay, it was a long video, 44 minutes, so sorry for that long video. Thank you so much. I hope it was useful. If you have any comments, queries, do share in the comment section below. Thank you so much. Thank you.